Are we on the verge of an economic nightmare we haven't seen in, what, 50 years? Some analysts are looking at the signals, and they're seeing some pretty spooky similarities to one of the toughest economic times in modern history. All right, let's get into it and see what the data is actually telling us. Wow. Strong words, right? I mean, that's a pretty bold statement, and it's really meant to make you stop and question the official story we're all hearing. The whole idea here is that the big headline numbers you see on the news, they might not be telling you the real story about what's happening on the ground. And this number, well, this is a huge piece of evidence for that claim. Negative 818,000. That's a massive, massive downward revision of job growth numbers from last year. It basically means the job market was never as hot as we were told. And it's exactly this kind of, oops, our bad correction that makes you wonder if the first numbers were ever accurate to begin with. So what's the whole argument here in a nutshell? It's that we're getting hit with the absolute worst of both worlds. The economy is shrinking, but the prices for everything you buy just keep going up. And that toxic mix, well, it has a name: stagflation.
Okay, so let's break down the actual signals that are causing all this alarm. What exactly is flashing red and making people think the official data is maybe a little too optimistic?
So what are these red flags? Well, first, you've got inflation. That's just hanging around. It's really stubborn, what economists call sticky. At the exact same time, the economy's growth, GDP, is hitting the brakes. And to make it worse, unemployment is starting to creep up. You mix all that together with those huge data revisions we just talked about, and you've got yourself a classic recipe for trouble. This isn't the first time an economy has stared down this kind of threat. So let's jump in the time machine and look at the historical parallel that's on everybody's mind: the stagflation of the 1970s. This is where the case really starts to build. Now this is where it gets kind of spooky. Look at how cleanly these parallels line up. In the 70s, you had oil shocks from war in the Middle East that sent energy prices through the roof. Today, we've got geopolitical conflicts messing with energy supplies. Back then, there was a ton of government spending. Today, we've had truly unprecedented levels of fiscal stimulus. And in both periods, you have a central bank that's really struggling to get a handle on inflation. I mean, the echoes are pretty hard to ignore. And that brings us to the most important player in this whole drama: the central bank, the Federal Reserve. What they do next is absolutely critical. And there's one specific, giant mistake from history that they need to avoid at all costs.
So what was it? What was the one pivotal error that turned a really bad situation in the 70s into a whole decade of economic pain? This is maybe the single biggest lesson from that entire era.
And here it is. It's called the Arthur Burns mistake, named for the Fed chair back then. See, he saw the economy was getting weak, and he blinked. He cut interest rates way too early, thinking the fight against inflation was over. But it wasn't, not even close. Inflation came roaring back, even worse than before, and it forced them to take even more painful actions later. The worrying today is that the Fed is facing that exact same temptation. All right, so if the outlook is this challenging, what's the game plan? What does the source material suggest you should actually do with your money? How do you navigate an economy with high inflation and low growth? The playbook they lay out is actually pretty specific. First up, commodities. We're talking about the real raw materials our economy runs on. Second, gold. The classic safe haven asset. Third, and this one's interesting, find stocks of companies that have pricing power. Think about a company with a brand so strong they can raise prices and people will still buy their stuff. That's pricing power. And last, stay away from long-term bonds, because inflation just eats away at those fixed payments over time. So when you boil it all down, the underlying strategy is pretty straightforward. In a world of stagflation, you want to own real, tangible things, or businesses that act like real things. And you want to avoid investments that just get eroded by inflation. It's all about protecting your buying power when the value of a dollar is literally shrinking. And that leaves us with this final, really critical question. The source material is basically painting a picture of a potential lost decade of economic pain, a lot like what happened in the 1970s. Now, whether that actually happens, nobody knows for sure. But the question of whether the markets and all of us are truly ready for that possibility, well, that's something we're thinking about.